Hello there, welcome to Berman's Call. And Larry Berman is here to take your questions on both large cap stocks and ETFs. You can reach him toll free at 1-855-326-6266 or email Larry at bermanscall@bnnbloomberg.ca. Larry, thank you very much indeed for joining us. We are getting a startup of the crucial US economic data, and we get a double helping of jobs numbers tomorrow.
We do. I think the thing to focus on here is something that Chairman Powell said last week in his press conference when asked about the state of the labor market in the U.S. And he said, well, the U.S. economy has been generating about 40,000 average jobs in the last 6 months, that the FOMC believes that they're still overstating the amount of jobs and that it's up to about 60,000 jobs a month overstated. So that would imply for the last 6 months, on average, U.S. economy has been losing 20,000 jobs. Some market participants are looking at that and saying, oh, the Fed needs to be more aggressive cutting rates. Yet others say, wow, if we're starting to lose jobs, that's weak economic performance. That's not good for equity multiples. So to me, Andy, that's the debate going forward here. Can we muddle through in a Goldilocks fashion? I know the U.S. administration wants to run the U.S. economy hotter, keep the stock market more robust in the midterm election year. 2026 is shaping up to be a very interesting dynamic.
Does the Fed go on cutting early in 2026, Larry? Where would you be on that debate?
When we look at what's priced into the market, we're essentially looking at one more rate cut, maybe two, between now and the end of next year. And then the markets are already starting to price in rate hikes beyond that. What that tells me is they're really worried about inflation. And the Fed really has to be very delicate in their assessment and balancing those two risks in 2026. It's going to be very, very interesting. I wish I had a crystal ball that was clear that would help me with that. But that's going to be my focus, I think.
Why would we get inflation? I guess companies increase prices whenever they can.
Well, listen, inflation on the supply side shock that we had from COVID is largely over. But we are entering a world, from my lens on the world, of less globalization. Less globalization means less efficiencies, means higher costs. So that's the world I'm seeing. The question is the new dynamic of artificial intelligence going to raise productivity enough to completely offset any of those inflationary pressures? History will tell us that technology innovation is very disinflationary. So there's the camp that believes, don't worry about inflation. There's the camp that believes, let's worry about inflation because the massive amount of government debt in the world is going to get very, very expensive if inflation comes unanchored.
So what about the stock market? Does the Fed really pay much attention to the stock market? I know politicians do, Larry, but does the U.S. central bank?
Well, the new unofficial voting member of the Federal Reserve in 2026 and beyond, called the White House, does care what the stock market does. And I think there's going to be some influence. We heard from Kevin Hassett over the weekend in the news media that he would be open to listening to suggestions from the White House, though wouldn't necessarily do what the White House said in terms of monetary policy, because it is multi-member voting system that dictates policy, not one person's influence necessarily. But again, there's a new dynamic in the FOMC that we haven't seen for decades.
That's right, Larry. They are volatile times for the U.S. Central Bank. Thanks very much. We're looking forward to getting your answers to viewers' questions in the next block. Please contact us. You can phone Larry or send an email. We'll put that number up. There it is. There's the number to call, 1-855-326-6266, or email Larry at bermanscall@bnnbloomberg.ca. An email from Jim to kick us off. Larry, what are your thoughts on buying a Canadian or US dollar ETF that tracks US stocks like the S&P 500? Is it better to buy in Canadian funds to reduce currency risk if purchased in a taxable account? I think that's what he's getting at. Larry, take it away, please.
Yeah, so when an ETF is purchased of a foreign market in Canada, whether it's hedged or not hedged, the cost of hedging is very, very real. So it's actually indifferent to you trading the one in the U.S. security in the U.S. name. There's still withholdings. There's all kinds of tax issues that kind of happen in the background. So there's not a lot of tax efficiency in terms of which way. Question is, do you want that foreign currency exposure or not? And my rule of thumb for now and probably for the next couple of years is if the Canadian dollar is 70 cents or lower, weaker, you want to make sure that foreign currency is hedged. I think fair value for the Canadian dollar is probably a lot closer to 80 cents or $1.25 in trading terms. And when we're at that point, that's when you would maybe seek that US dollar exposure. So those are sort of my guidelines at the moment, and that could change. You could see there over the past year below 70 was a great opportunity in this case to hedge your foreign currency exposure as it got closer to 74, the other way. So now we're drifting back up to those levels. I don't think we're going to get much beyond 74 or 75 anytime in the next 12 months. If we do, I'm going to change my view on where we're heading here in the short run. But there was a pretty dramatic shift that happened during the Canadian employment report recently. And if we see another strong Canadian employment report, that could push the Canadian dollar to be quite a bit stronger.
Okay, thanks for that question. We have Ken calling from Vancouver. Go ahead, Ken, please.
Oh, hi. Larry, I'm trying to build a portfolio in my taxable account that is the most tax efficient as possible. Some income, some growth. Is there a fund family you can recommend or specific ETFs that factor in taxation? Thank you.
Yeah. Global X has a suite of ETFs that are executed by way of a total return swap. And those are the most tax efficient. There's a slightly extra cost to them, but if you look at them on an after-tax basis for taxable investors, that's going to be your best exposure to foreign markets. The real benefits to a Canadian, of course, are CRA-eligible dividends. Those only come from Canadian corporations. So if you're buying exposure to a foreign security, even though it trades in Toronto, the S&P 500, MSCI, EFI, even though it trades in Toronto, that dividend is not treated tax efficiently. It's treated on account of income. So you want to think about it that way. I've recommended for current income seekers, the ZWU and the covered call exposures because you get a big percentage of that return coming by way of capital gain, which of course is your most efficient way of paying tax to the government. So those are some of the rules of thumb that I would think about in your investment.
Nazar is on the line from Scarborough, Ontario. Go ahead, please.
Oh, hi, Andy. Hi, Larry. May I have your thoughts on TELUS, please? This is regarded as a good dividend stock. However, TELUS has decided to pause dividend increase. At the current 9% yield, is the dividend safe? Also, your thoughts on telcos in general, please. Thanks for taking my call.
Thanks.
Yeah, and so, recognizing that Bell is the head of BNN, I don't remember the exact language that we like to use here on the air, Andy.
Parent
Maybe you
company.
can correct me after I'm done.
Yeah.
Parent of BNN Bloomberg, for sure. I think you're going to see what's gone on in TELUS recently, not that different than what's happened to BCE in recent years. BCE's got a few other issues that I don't know that TELUS has, but I think you're going to see pressure continue here. And this is why I've said for the dividend seekers, ZWU gives you a better equivalent yield after all, and it is considered and gives you more diversification than just trying to pick TELUS or BCE or any of the other, well, I guess Rogers would be the other one. So I like ZWU. When you look at a chart of ZWU long term, what you don't see, because on BNN here we only show the price chart, it doesn't show the total return. And so you're clipping a coupon here of around 7% annually, and very tax efficient. So I really like ZWU as for Canadian investors in taxable accounts when you're looking for higher income, as opposed to trying to pick which telco or utility might deliver that for you.
Okay, Fatima is calling from Lethbridge. Go ahead, please.
Hi, Larry. My question is on ZFL. What do you think about it at these levels?
And that is, I believe, Larry, BMO Long Federal Bond Index. So is it U.S. bonds?
Yes. So this is Canadian. This is the Canadian government long bond, ZFL.
I see. Okay.
ZTL is the Treasury long bond.
Okay.
In the U.S. So they have a ZTL and a ZFL. So BMO Federal Canadian long bonds. I think long bond yields in Canada have likely already come as close to their lowest yields that we're likely going to see, and therefore a bad investment. I would much rather have a ZTL and wait for a harder economic landing in the U.S. where we see long bonds rally. Right, we've had a big difference between Canada and U.S. long end in the last year and a half. And I would much prefer, if you're going to play long bonds, to play treasuries over government of Canada's.
Okay, we have an email from Max. I want to add a US ETF, and I'm looking at VEA, EFA, and ACWX. All have done well, and they have a dividend yield over 2.5%. However, their expense ratios are a bit different. Any of those names jump out to you, Larry?
Well, they're all actually very different exposures. So when you get the Vanguard one that's 3 beeps, that indexing strategy for international markets includes South Korea. When you look at the EFA, it does not include South Korea. And where you look at ACWX, it actually has Canada in it. So you're getting 3 different exposures, very hard to compare which one. But the most efficient one, if you're looking at buying a US one, of course, is likely VEA. You can see the difference in returns over the last 5 years there in terms of those ETF exposures. But the difference between EFA and VEA is the South Korea component, and then the difference between ACWX and those two include parts of emerging market. There's some China exposure by way of Hong Kong securities in there, although you do have some Hong Kong exposure when you get an EFI exposure. I know it's a little complex. Don't focus on the MER. Focus on the right exposure that you want to get for your investments, and let the ETF MER be the tiebreaker, all else being equal.
We have an email from Bill. I'm looking for a safe investment to hold cash. I have previously invested in ZST, which is currently yielding 2.9%. I see ZUS.U yielding 4.6%. Is that a safe, non-volatile investment? I'd like to take advantage of the higher yield.
Yeah, it is. It's a U.S. equivalent type strategy. Money market rates or short-term corporate rates in the U.S. haven't come down. Bank of Canada has rapidly cut interest rates. The Fed is starting to. So you're going to get a natural higher yield in the U.S. The difference being if you need that U.S. dollar yield and income. right, versus Canadian, because you've got to now consider, yes, it's a higher yield, but now I'm exposed to the US dollar as opposed to having a Canadian dollar investment. So you have to take a currency view there. It's a great question, but it's not as simple as looking at the yield. You got to look at your currency exposure too, because that .U unit gives you that extra yield, but the exposure to the US dollar.
And we have an email from Dan. Which of the high-yield overlay ETFs do you currently favor for 2026 investing, both in non-registered and registered accounts? I am looking at the Purpose CNQY. Thank you.
Yeah, I have concerns with some of these ETFs that wrap, covered calls narrowly. So this is CNQ stock with a covered call on it. If you're bullish on natural gas, just buy CNQ. Better yet, buy FCG, which is a broad-based ETF that holds a lot of natural gas exposure, though trades in the US. So a couple of things to unpack there. I wouldn't say that any one of these is better than the other. You're making a call on a stock, and right here, right now, I don't mind natural gas, but if you're bullish on CNQ, forget the extra yield. If you're bullish on it, just buy CNQ. Again, a lot of these things I would call gimmicky. If you're more defensive and you want that extra yield, then a CNQY is appropriate, but remember, it's a much more defensive type way to get income into your portfolio.
Coming up, Larry brings us today's educational segment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. Time for Larry's educational segment. Take it away, Larry.
Andy, off the top of the show, I talked about Powell and the idea that the FOMC believes that the U.S. could be losing jobs. So tomorrow's employment report is going to be pretty interesting. But what's happened really post the FOMC last week and post the most recent Bank of Canada meeting and after the Canadian employment numbers is related to the first chart here. We're seeing, current overnight rates based on that are implied based on how the futures market is trading, and we could see that we're basically pricing in about 2 more rate cuts with the potential to maybe 2.5 through middle of 2027, but then starting to price in a bit of a tightening pattern after that. I actually think that thinking is completely out to lunch, because when we look at the S&P 500 analyst top-down consensus. So the next chart here looks at what are all the strategists saying, and they've surveyed 24 of them. And these 24 strategists think the S&P year-end target next year is around 74.89. You can see there for about 9.7% index growth as of Friday's close, with an estimate of earnings growth around 12.6%. So the strategists are saying, boy, the economy is going to do really, really well next year. Earnings growth is going to be great. We're going to have another real good year for equities. That really doesn't support what the market is pricing in terms of Fed policy. I would argue if we get that kind of earnings momentum and the S&P is strong, we're not going to see any more rate cuts. And in fact, the next series of cuts is likely to be once the U.S. economy starts to falter. And so I think equities and messages from the bond markets are telling us different things now. When we look at the bottom-up aggregation consensus, so the next graphic here, This takes the current 503 members in the S&P index and looks at all the analyst consensus for the end of next year, rolls them all up and weights them by the index. It's coming up with a target of 79.38. Now, historically, we've never, ever hit those targets. You can draw these forward-based projections back for decades. The markets never reach those targets. So don't use that as your target. But what it's telling you, again, here is that analysts are very, very optimistic. And that's not really what the Fed funds futures is pricing in my mind, and kind of what we're seeing in terms of some of the messaging coming out of the bond market. So I think as we look into 2026, we have some challenges here. And last week we talked about valuations, and one of the things that I've been advocating is rebalancing of portfolios to maintain your market exposure, but to shift to investment strategies that are going to generate more income, perhaps in private equity or private credit markets that are still going to deliver on your long-term rate of return higher than the rate of inflation. Always trying to time markets is extremely difficult, and valuations right now are just not compelling in public equities. That's been true for the last year and a half, yet markets keep going up. So it's going to be a challenge from an investment perspective, I think, in 2026. And I'm seeing a lot of these things to me that don't add up. And that tells me something very different is likely to happen next year. I wish I knew what it was, Andy.
And Larry, what is your thought on the massive build-out? We've heard of AI. We've heard some observers say, well, OpenAI may be the weak point or a weak point here with a massive amount of debt and no real revenue or nothing, pretty small revenue anyway.
You know, part of private equity at Q Wealth, I was offered an opportunity to invest in OpenAI's most recent round of finance. And we just looked at the numbers. And while I would love to get that exposure, we passed on the opportunity. So, you know, I'm in that camp. But I think while it's not a bubble in the sense that there's real economy, these are real products. It isn't dot whatever like we saw in the late 90s where everybody was getting involved. But there will be a washout and a cleansing. Why, Andy? Because there always is when things get a little frothy. We just can't time it with any precision.
Larry, thank you very much indeed. Larry Berman. And remember, Larry Berman, his regular slot, 3 p.m. on Mondays on BNN Bloomberg. There's where you can get in touch with him online. QWealth.com is his basic website. We'll be right back with the close.